Hi everyone, I'll give you a summary on my recent sector note on oil and gas space. We have a positive view on refining and marketing as well as in natural gas space. However, we have a negative view on upstream companies, mainly ONGC Oil India and Kane. Starting first with refining and marketing, we expect healthy refining business, healthy GRMs, mainly on the back of three reasons. One, refinery capacity rationalization of 0.75 million barrels per day from Europe and Japan. Second, higher discounts from the Middle East countries. And third, deferment of large capex and refining capacity addition from Europe, Middle East as well as in China. So these are the three major reasons behind healthy GRMs. There is a higher petroleum products demand globally. For 2016, we expect petroleum products demand to grow 1.3 million barrels per day against the net capacity addition of 0.9 billions per day. This will give us the lesser supply in the international market for petroleum products, and thus it supports the healthy GRMs. Post deregulation of diesel as well as in petrol, we have seen higher marketing margins in petrol and diesel. Moreover, DBTL scheme in kerosene will again boost further the profitability of refining and marketing companies, mainly HPCL, BPCL and IOC. Amongst the three, we preferred HPCL first, IOC second and BPCL third. Starting with the natural gas space, where we have positive bias, we have seen lower spot NG prices structurally for next couple of years. We expect spot NG prices to remain in the range of $4 to $5 per MMBTU, mainly because there is an incremental capacity addition from Australia, that is 30 million per ton in 2016, as well as 15 to 20 million ton in 2017. Also, removal of export ban from US would put further pressure on the supply side. However, on demand side, there is a weak demand. Japan, which is the largest consumer, where we have seen since last 2 years there is no improvement in demand as such. Thus, we believe that spot NG prices for 2016 and 17 would remain $4 to $5 per MMBTU, which is the biggest positive for Indian companies like transmission companies as well as city gas distribution companies. Moreover, there is a regulatory change in transmission tariffs would add significant positives towards transmission companies' profitability. Thus, we like GAIL, GSPL as well as Petronet LNG in natural gas space. Starting with the upstream companies, where we have a underweight rating on ONGC Oil India and Kane, mainly because we expect a crude oil price to remain under pressure for 2016, mainly because weak economic environment in Europe and China. And second most important, incremental supply from Iran around 1 million barrels per day, which will put pressure on crude oil price. However, going forward, US is the major driver of crude oil price, mainly because from October 2015 we have seen lower production in US. If crude oil price goes above 50, then we can see shale gas and shale oil production to ramp up again. However, on overall basis for 2016, we expect crude oil price range would be around $40 to $50 per barrel. Coming back to the domestic companies like ONGC and Kane, where we see limited trigger on operational front. Since last 2 years, we have not seen any major growth in production in all the three companies. Adding to that, there is a weak crude oil outlook and gas price outlook, which will put significant pressure on their profitability. Thus, we remain underweight on ONGC, Oil India and Kane. Coming to large cap companies like Reliance Industries, where we have a positive view, we believe that company will deliver on its core business, mainly on the back of downstream project launches, where we can see margin improvement even if cycle doesn't improve from here on. If you look at the petrochemical segment, globally we expect demand to grow by 4% compared to 3% growth in supply. Major capex in Europe as well as in China has deferred. This would support margins in both refining as well as in petrochemical segment. Considering lower crude oil price, we expect company will still earn 18% ROC on its refinery of West Cracker project, as well as $2 per barrel on petcoke gasification plant. Considering the soft launch or high invested projects like in telecom, If Reliance deliver on RGO, then we can say significant re-rating in the stock price as well as in the earnings. Thus, we believe that Reliance is in a sweet spot to cater growing demand globally over the next couple of years, mainly on the back of its downstream project launch. Valuations are also at a reasonable level, around 10 times FY18 EPS compared to its long-term average of 14 times. We remain positive on Reliance for 2016.